Yeah, hearty welcome to all the participants, the invitees on the dais, and Dr. Subir from Bombay, and Dr. Anand Nageshwaran from Singapore. Thank you, Dr. Subir and Dr. Anand Nageshwaran, for joining us. And so I'm going to briefly introduce what is this event triad and the topic, but I'll then hand it over to Professor Charan Singh, who will take over the panel discussion. And so that's the way we have designed it today. So I'm the chairperson of the Center for Public Policy, and one of the recent initiatives I've taken is that we thought we'll have this, I wouldn't call it really a formal and then a seminar type, it's more like a workshop where we intend to call specialists from respective fields and then have a, let's say, a current topic discussed. I mean, it may not be very research based, but we want to really pull out the insights from people writing on it and the practitioners working with the problem, In fact, 10 days back we had organized, but it couldn't happen. We had called the Minister for Food here, and we wanted to have a session on food security. But unfortunately, the Minister had to go urgently to Delhi, so it couldn't be, but it will be done very soon. So idea is that we take up a topic, prepare a background material on that, and then have specialists to speak on that, both from the academic and the practitioners world, and then get a broad idea of what's really the whole issue is about. Because what you really get from the papers or TV is really like very reactionary and responsive. Not so much of insights or reflective and like that. So we thought we should have more of these sessions, and then we'll capture it and maybe we'll mail you back later the transcription of the discussion that we'll be having today, along with some data we'll be posting to you, So we have, I meant it to be in a very humble way, but Professor Charan Singh, once he got involved, he really escalated to a very macro level, so he was very successful in getting Dr. Subir Gokan to join this panel, and then Dr. Joshi to join this panel, and then he also was successful in getting Dr. Anand Viswanathan from Singapore to join this, and my only contribution has been Shekhar Viswanathan, if I can claim a credit for that, and so we have a very interesting panel, and then we thought that we should have a banker, and then we should have an economist, and we should have the rating agency also, a person who have been really critically looking at all these issues. And Anand Nageshwaran he's an ex-banker, he's an ex-academician, and he's a prolific writer also. So that way we have very balanced and a widespread, I would say, a range of specialists to speak on this topic. And I don't know, when we started talking, Sharon and me, we just stuck upon this topic, $65. It looked to me like chicken 65, so it really rhymed with that. So we thought that it gels well. Even though actually rupee, which is $65, is not 65, And we were hoping that when we gave the price, will it still be 65 when the workshop really happens? Because we decided it about a month back, and I should say it didn't really fail us. I was just asking them, is the price is over? They said, no, it's still not, don't worry. The workshop is still valid. That's what they told us. And now I request Professor Charan Singh to take over.
Thank you, Professor Ramesh. Welcome everybody to this beautiful event-type discussion on $65. As Professor Ramesh has mentioned to you, I am one of the people who thought it should certainly go beyond 65, and rest of the country said no, 65 is a good value, and I thought $65 was fascinating, and this should be our topic for this beautiful discussion. My plan of action today is as follows. I'm going to briefly introduce you to the panel participants. Actually, none of them need an introduction. All of them are so well known, but I'll just do this formality. And after that, I'm thinking of making a small presentation which would probably set the base of the discussion today. And then we will go ahead asking views from our esteemed panelists. To introduce you to the panelists, I would like to start with Dr. Subir Gokan. He was my boss at the RBI when he was the Deputy Governor of the Reserve Bank. And right now, he's the Director of Research, Brookings India, and Senior Fellow, Brookings Institute, Washington, D.C. You have the profile of his in your papers. Then I would like to introduce you to Dr. Dharmakirti Joshi. Dr. Joshi is the chief economist, CRISIL, and you would have recently read the report which they have come out on the state of the economy. Dr. Anantha Nageshwaran is joining us from Singapore on the Skype. He is currently the consultant economist with Asian Economics, an independent macroeconomic research institution. He is an external advisor on investment strategy to global capital investors and independent asset manager based in Singapore. Finally, Shekhar Vishwanathan is joining us from the industry. He is the Vice Chairman and full-time Director of Toyota Kirloskar Motor Private Limited, and he comes with 33 years of experience in the corporate sector. He has been with Toyota Kirloskar since 1998. You have the profiles of each one of them, and then I think now I should, after this brief introduction, go ahead discussing a little bit about the topic that we have on hand before I open the panel for discussion. What I thought is, I'll show you this beautiful cartoon. And why did this happen? So the cartoon is telling us this round coin is toppling down the hill all the time. Should we have a square coin which will be more stable and not topple all over the place? This is all that happened after the rupee started its roller coaster journey. On a serious note, this is how the exchange rate looks. Are the data the latest that we have? And why does the exchange rate look the way it looks? Why did it depreciate so rapidly? There could be different theories, and in an academic institution it is obvious. You would ask, what are the determinants of an exchange rate? Mainly two. As the theory would suggest us, importantly, interest rate differentials and the inflation differentials. This is how the inflation, if measured in CPI, looks between these two countries, India and the US. And this is what we saw as far as the exchange rate of the India and US is concerned. So the gap has been widening between the inflation of these two countries, and probably that is reflected. It's not today, it's not yesterday, it was not last year. If you look at the exchange rate from 93-94, after we did a major upheaval, India suffered a major upheaval, and we reformed our exchange rate system. If you look at the exchange rate from then and look at the inflation differential between the two countries in the range of 3.6%. Now, to a great extent, this was explained in terms of current account deficit. And this is how our current account deficit looks like. It touched 3% in 1991-92. The balance of payments high-level committee chaired by Dr. C. Rangarajan proposed it should not be more than 2%. We religiously maintained it at 2%, and in the last few years, it just got out of all the barriers and limits and touched 6.8% in the last quarter of 2012. It averaged for the whole year around 4.8%. This is a very dismal performance. Now, the deteriorating current account deficit was blamed on two items, oil imports and gold. Now, normally you would anticipate if the price is rising, the demand would go down. But this is the story as far as oil imports and quantity of oil imports are concerned. Quantity of oil imports have been rather reluctant and stubborn. The prices might have moved here or there. More interesting is the story of gold. Now, we all know in India, according to the World Gold Council, 18,000 tons of gold is held amongst the households in India, the largest in any country. Now, gold demand has been basically coming from the rural areas. 70% of the gold purchases are restricted to the rural areas. Could it be because of the uncertainty and the inflation? Well, I'll just show you the graph. But before that, this is how the price of gold looks over the last few years. It's been going down in recent months. I've plotted the imports of gold and inflation, and you can see how the correlation looks pretty close. Could be hypothesized then that it is the uncertainty which is resulting in such gold imports, Even central banks have started buying gold now. Once again, back to our story of the US dollar and the rupee. This is the latest trend in the rupee dollar rate. This is the last 3 months. I will show you a longer time. This is the last 3 months. And this is how it moves along with the Nifty. Another trend along with Nifty, 18-month trend. As you can see, when Nifty is stable, how the USD rate moves. Also has a relationship with the FI's flow. Now here comes the story of the Fed tapering, and then we all know what happened. This is not only for India, but exchange rates across the emerging markets have taken some hit. What is happening here? I want to narrate briefly a small story. This is how the foreign exchange reserves look like, the latest data that we could have comparatively for all these countries. China holds more than $3 trillion. India is hovering between 270 to $300 billion. If you look comparatively, this is how the picture is, and I am showing the picture from 96 onwards to the latest. And as you can see, from 96 onwards, the story of international reserves has been changing. Why did I take 96? I would like to mention. I wanted to take a year before the Asian crisis. So it gives you a trend. How international reserves have been rising, sort of precautionary motive from uncertainties globally. As a percentage of GDP, little muted, but again reasonably high over the trend, over the period. As far as India is concerned, foreign exchange reserves to GDP ratio has been rising, but more importantly, if you look at the import cover, the reserves required to cover the imports in a year, they were pretty high at one point of time, 14 months. And then they have been coming down. It's just about 7 months now. Taking a global view, this is how the US long-term interest rates are there. The trend seems to be reversing, and that is what the story in May happened when the Fed Reserve signaled they could be reversing the easy monetary policy or the unconventional monetary policy stance. Some factors which we would like to consider. If you look at the global picture, the gross debt of countries, advanced and emerging countries, has changed over the years. Please look at the last row, USA. Debt to GDP, this is percentage to GDP. Debt to GDP ratio has been rising, almost double. And so is the story true for Ireland, also partly true for Japan, Portugal, Singapore, and across. Everybody is having that. As far as emerging countries are concerned, India did have some fiscal space. Debt to GDP ratio for India has come down from 70 to 66%, which is good. But for others like China, it has gone up. For Indonesia, it's come down. Russia has gone up again. South Africa gone up. If you look at the consumer prices, again, you will see that for India, consumer prices in India has been significantly different and large than other countries. 10.4%. And here I've shown you for a number of countries, we are on CPI doing the worst. As far as the current account is concerned, well, I just mentioned to you what happened to our current account deficit. I won't say that we are the only ones who did so badly, but amongst the emerging countries, here is the trend. 4.8% is what we are averaging, other countries are not. If you look at the advanced countries, of course, we have Iceland 4.9%, but then UK is minus 3.8%, but others are not that high. Overall fiscal balance of the government, India is again at minus 8% amongst the emerging countries, not very good. I have used this data from the World Economic Outlook, and the Global Financial Stability Report released by the IMF yesterday. So it's just from the bakers. Very, very hot data. Okay. Given this little background, I wanted to mention the US dollar rupee rate, and as of now, the US enjoys the reserve currency status. And some of the questions which I'm going to pose to the panelists and learn from them are going to be related to this. The reserve currency status is not for all times to come. I've just plotted for you different spans of time. Reserve currency status does move from one country to another. It's the US now after the Second World War. It was Britain earlier, and of course France before that. The graph shows you the trend. So, this is the BRICS story. Will we be able to change the story? Did the recent global crisis change something? These are the issues that must be in the minds of almost everybody. With this, I close my opening presentation, and I thought it's now time I go down panelists and talk to them about what they think should be the direction of our policies and what is in store for all of us. To start the discussion, I propose to ask Dr. Sudhir Gokran the first question, and after he gives his views, we'll go to the other panelists for their views. Dr. Gokran, we would like to know, in your view, we had this question for you, in view of the shutdown of the US economy, which has now been there for almost a week and do not know how long it will last, do you see any impact on the Indian rupee?
If you look at what's happened with rupee as well as several emerging market currencies in the last 10 days after the shutdown was effective, rupee is actually appreciating. So what this suggests is that there is a temporary outflow of funds from the US into the global economy, the global marketplace. And this has been spread across countries based on various investors' weights assigned to different economies. So India has clearly benefited in terms of inflows from this process. Now, the question is that would this mean that if the government is to resume, and obviously at some point it will, you cannot visualize the shutdown as a permanent phenomenon, then is this going to reverse? In other words, are we going to see some depreciation of the rupee when money goes back to the US as a result of the government resuming? So I don't think we should see this as a sort of, at least in the short term, as something of lasting significance from the currency. At this point, markets are working on the presumption that the government will resume and sooner rather than later. And in the meantime, let's try and take advantage of whatever short-term arbitrage opportunities are available. Once the resumption happens, there will be some sort of correction and rebalancing, and the rupee may lose some ground within that. The two factors I think we have to keep in mind in terms of risk. One is that while there have been precedents for government shutdowns in the US, there has never been a precedent for a debt ceiling being reached. And I think from the perspective of global financial stability, this seems to be a much more significant risk. If we do not have agreement by the 17th, there is no precedent, so we have no idea what can happen. There is no model that will predict the consequence of this for global capital flows, whether will they apply to safety, will they be applied out of the US, will they be applied back to the US, who knows what will happen. Keep in mind when in 2011 the US sovereign rating was downgraded, they actually saw money going back to the US. So this is a rating paradox where the cost of borrowing in the US went down and the result of its rating being downgraded. So, strange things happen. There are all kinds of possibilities with this very, very complex financial market landscape. But I think it would be safe to say that countries that have high level vulnerability and should be bracing for some upheaval. Our pattern over the last 2 years, you brought that out in your presentation, has been that as the current account deficit has widened, and you showed how sharply it has widened in the last couple of years, the impact of the currencies for any global shock to translate into very, very sharp up and very, very large movements in the rupee. And this is a correlation which is very strong globally. And as long as our current account remains in the zone of vulnerability that it is now, any global shock, however, wherever it originates, is likely to have a sharp impact on the rupee. So I think we've got to be very watchful of this. And if we get over the hump of the debt ceiling increase and so on, then we have a few months of breathing space to try and get to grips with the current account, and we have to use that as effectively as possible, because the next shock that's going to hit is the taper. When it will come, we don't know, but I expect that it will only come after the new chairman takes over, and that means essentially the second quarter or so of 2014. So we have for a 6-month window, during which time we have to put strategies in place. The impact may not be immediate. We have to have strategies in place to address the pressure points on the curve.
Thank you so much. I think our other panelists may have a view. Dr. Joshi, would you have a view on this?
Yeah, I broadly agree with what Dr. Gokan just said, but I wanted to add a bit of the S&P's view on the shutdown. I think it's one is that it's definitely going to slow the US economy down. And the estimate is that the fourth quarter GDP will fall by 1.2 percentage points if the shutdown continues for a month. And so progressively, I mean, if it continues even later, then I think the magnitude of impact will only increase going ahead. So I think this slowing US economy does have some implications for exports, etc. The second channel is what was mentioned was that I think it's not a shutdown alone. It's the combination of shutdown and the debt ceiling which is causing a lot of problem. And this can very significantly hurt the business sentiment, and we don't know. And I think right now with a high current account deficit, you are dependent on global risk appetite. So if it messes up with the global risk appetite, then you have a danger of capital outflow. Hard to predict at this juncture. And then finally, I think, and this can have an impact on rupee. I think the other implication of this shutdown is on the availability of data for the US economy. If the Bureau of Labor Statistics doesn't release its employment numbers, unemployment numbers, and Fed is saying that it will depend on the availability of data for its decision, so it is creating another confusion on the decision-making part of the Fed. So it's adding another layer to uncertainty. And data will definitely not be available if the shutdown continues for some more time, because Bureau of Labor Statistics is also impacted. So some bad news for economists also here. So I think overall it depends on how long it continues and what is the and whether the debt ceiling is taken care of or not. If it's not taken care of, then I think it can again create ripples across the emerging markets.
From the industry, Mr. Shekhar Vishwanathan, if he would like to share his views.
Yeah, good evening to all of you. Yes, I would like to give you all one straight thought that I have on this whole issue of the shutdown and the debt ceiling, which Dr. Gokan alluded to. I think the debt ceiling is a serious issue, but I don't think the US is ever going to default. Now, how they're not going to default is not through agreement, but I believe they're going to do what India did in 1991, if they've not already done that. And that is, they have a lot of gold, they can pledge it, get some money, and keep at least prevent the default from happening. That's maybe one solution. I'm not that well read on how they manage their treasury operations. This is just a straight thought.
I'm so excited to know that the Americans will have to pledge the gold. They made us pass through hell in 91 when we had to pledge it. I wish they had to pledge it with the Reserve Bank. Well, I would like to seek the views of Dr. Anantha Nageshwaran. Would you like to share some views on this question with us?
I think Dr. Gokan has quite comprehensively laid out the outlook for the rupee in the short term. So basically, let us have the impression that This is not something that we should take it for granted that rupee has strengthened the work behind it. I largely agree with that sentiment. Yes, there's been some funds outflow from the US, and whether or not the fund outflow reverses when the US government gets back to work, and even if the debt ceiling issue is tackled and resolved, either permanently or series of temporary debt ceiling increases. The underlying fundamental picture that you very clearly presented, the fiscal deficit, the current account deficit, the inflation differential, etc., are clearly going to be holding back the Indian rupee from rallying. If anything, I would say, in your title for this evening's panel discussion, you had given $65. I think Indian rupee is now currently trading at the stronger end of the range between 50 and 65. So, a short-term market participant would probably be looking at this level as something very tempting. Either to close their long position in the Indian rupee or even have the guts to open some short positions, because I think the strengthening has happened a little bit too soon and without much improvement in the fundamental outlook of the Indian point of view. So, and then there is also one more factor that I would like to bring, which has not been left upon, is that the US stock market is based on the cyclically adjusted Schiller PE ratio is trading around 23-24 times, which is doesn't look that unreasonable if you compare it to what happened between 1999-2000 and compare the level that prevailed in 2007. And of course, the feeling is that as long as the Fed is printing money, whether it is $55 billion or $85 billion per month, and buying securities, there should be no fear of the US stock market. But then investors, long-term investors will know that there is always one excuse or the other for both to keep hoping that bubbles will continue forever. So should the US stock market actually undergo a nasty correction for whatever reason, I can't put either a time frame or a trigger to it, then I think funds flow into emerging markets will definitely fall. India will definitely be vulnerable, and regardless of whether the United States is working or not working, or the debt ceiling is lifted higher or not lifted higher, if that even materializes, then I think India will be one of the countries to be affected. So I think we certainly are not out of the woods yet, and whatever has happened in the last couple of weeks or maybe more is something that we should enjoy while it lasts.
Thank you so much. So the nutshell of this question is beyond vulnerable. I've been thinking about this shutdown myself and thought, thank God in India this doesn't happen, because our metros and everything would stop if there was a shutdown. In the US, everything is privatized. If there's a shutdown, it's just the White House which is closed, but at least everything else is working. Okay, I think it's time to move on to the next question. And here is a question which I thought I'll ask Dr. Gokaran once again. The IMF World Bank meetings are on, and they've just released a paper on unwinding of the unconventional monetary policy. And I would like to know that they have been warning the emerging markets about the difficulties associated with the unwinding of the unconventional monetary policy. And we would like to know Dr. Gokaran's views on the impact on the Indian rupee of this unwinding.
You first have two bills attached to the bare bills to maintain balance, even if the creditor himself or herself has not found that balance. And at some point you take those bills off, and if you actually observe kids who go through this transition, you find about half of them fall the first time the trading bills have been taken off. And the other half vanished. So when you look at the rollback of unconventional monetary policy, to me the situation is analogous to removing the trading deals from the global financial system. Because what we've had over the last 5 years as a result of QE1, QE2, QE3, the ECB's liquidity provisions, the Bank of England's liquidity provisions, the Bank of Japan's liquidity provisions, and many more central banks pumping liquidity, is that we've added a kind of set of trading bills to the global financial system, which has kept both asset prices and commodity prices elevated to levels which are completely inconsistent with the underlying fundamentals. You would never have these kinds of valuations in a situation where liquidity was what I would call normal and growth numbers will be so sluggish. So those trading fields are actually kept, asset prices high, global capital flows very robust, and essentially the motivation has been purely liquidity. Now, what is the transition that we expect to happen? The transition is essentially that with handing over the responsibility of keeping markets afloat from liquidity to fundamentals. So the justification or the rationale for the Fed unwinding its QE positions is that it believes that the US economy will now come back to a track which will allow asset prices to remain reasonably robust without the support of liquidity, and that's the way in which this process is going to unwind. Now, if the US is withdrawing liquidity, it's rolling back, and this is obviously the most significant contributor to the global liquidity pool, we have to look at what is happening in our economy. And there I think we certainly face some risk, because basically if we have to take the trading fields off, we will have to balance or fall on the basis of fundamentals, and our fundamentals don't look so good. There is a current account deficit which is very large and a great source of vulnerability in this global turbulence. There is a fiscal deficit which, although there are commitments to bring it down, is still at a very high level, and there are doubts now about how this 4.8% target for the year, the budget estimate, will be met. What does it mean in terms of expenditure reduction in the face of revenues being not as buoyant as assumed in the budget making process? So if that's the case, then we could be experiencing a fall. So in some economies, the ones that have fairly solid macro fundamentals, low inflation, low current account deficit, low fiscal deficit, will probably be able to ride the storm. They will continue to ride even when the trading fields balance, even when the trading fields are off. Other economies, and I certainly would put ourselves in that category, risk falling. So what do we need to do? I think the message is very clear, whichever way you frame the question, that we've got to address those fundamentals. And to the extent that the time frame that the Fed has put on tapering is now giving us some window, strategies to address those fundamentals, they're not going to have impact overnight, no question. But we need strategies. We need explicit strategies to address the current account, we need explicit strategies to address the fiscal problem, and we need explicit strategies to address the food problem, which is the basic driver of inflation right now. So that's what we need to do, I think, to get those, to be able to balance ourselves when the trading field are taking off, which unquestionably they will in sometime during 2014.
Dr. Anantha Nageshwar, would you like to add something or share something on this?
Perhaps, in fact, I just wanted to say something on the question that or the remark that you made at the end of the last round. You said, thank God we don't have a shutdown. But I thought we have been having a shutdown for quite some time now, a government shutdown. So I'll leave it at that, because certainly we haven't had too many decisions happening in this country. So in some sense we are more used to shutdown than in the past. But that being said, I think the fact is very clear. I mean, what this episode of rupee weakness has brought about is the acceptance that fundamentals eventually do assert themselves. And in fact, you showed the chart very well with the function of inflation, which in fact, if you regress or simply plot the exchange rate, actual exchange rate of rupee against the dollar, versus the inflation differential between these two countries, the US and India, regardless of the starting point, whether you begin at the end of 91 or 92 or 93, assuming that the rupee was reasonably valued after 2 rounds of devaluation, or maybe even 3 between 91 and 92, or if you start in 1996 when the dual exchange rate was abolished, the fact remains that the Indian rupee is actually, according to this particular measure, is fairly balanced between 66 and 68 rupees to a dollar, and right now, in fact, we are actually stronger than its indicator. So, in that sense, as long as the fact that India's inflation rate, consumer inflation rate, reflects a differential of over 6 percentage points in the US as reflected in their official CPI, no matter what the actual inflation rate is in the US, then I think the rupee depreciation of around 2 to 5% is something that corporate India will have to factor in. And the window of opportunity for India to act is quite narrow, but we have our own political calendar, regardless of the tapering calendar in the US. And to that extent, I don't think major structural reforms which should lift India's potential GDP growth rate will happen between now and probably the next 12 months. After all, the latest World Economic Outlook, we are reducing potential GDP growth rate of India to 5.7%. They have estimated to be 5.7%. I think on the basis of what we see, perhaps it is somewhere between 5 to 6 months or 5.7. So there is a lot of work to be done, but there is also the realization that not much substantive work will be done in the next 6 to 12 months. And to that extent, the vulnerability of the rupee is heightened, and the stronger the rally the stronger and the longer the rally lasts, the more painful will be the eventual correction that has to happen if fundamentals do not improve.
I totally agree with your comment. I have been myself thinking it's very strange that our large neighbor, China, generally keep their currency depreciated, and we in India generally keep our currency highly appreciated. And I myself have been calculating and I've been saying, along with Tarapur and others, that the true value of the Indian rupee based on the inflation differential hovers around 68 to 70. And I know that we all know about beggar thy neighbor hypothesis, but I do not know why India likes to pursue enrich thy neighbor hypothesis. You keep a highly appreciated exchange rate and let the exports of all your neighbors keep taking over your export market. So I do agree with you, but I would like to know how the industry thinks about this. Would you like to tell us something, Mr. Vishwanathan, on this question of the unwinding, and how does the industry perceive the impact of unwinding on the rupee?
No, I mean, obviously we don't want a falling rupee. We want a more stable rupee, but I think we've heard Dr. Gop, and I don't have any fresh views to add to that.
Sure. How about you, Dr. Joshi?
I think I'll just reiterate that in this environment where your vulnerability is so high, I mean, the current account deficit is coming down, and some of the reasons are coercive methods to bring down the current account deficit. I mean, the fundamental that should lead to the correction of current account deficit would be the fiscal side and the inflation side, which is yet to happen. But I think when the global liquidity and risk appetite matters so much for us, I think an event like starting of tapering, even if it is priced in by the market, people can argue that markets are forward-looking. But I think when it happens, I think it's definitely going to cause ripples, and depending on how it is paced out, slow or fast, I think we feel the impact. But I think some positive news on that front is that at least we have started building a war chest. I mean, we have money coming in through FCNRB, and also I think the remittances are pretty strong this year. So I think all these things will come in handy at that time, and so impact may not be that big as it happened during as we witnessed during August. But yeah, definitely there will be ripples, and how it is contained will depend on the war chest that we have.
Dr. Joshi, you just mentioned about the current account deficit, and I was thinking, let me ask you this question directly. Current account deficit has been a cause of concern. It's being talked about even in the parliament everywhere. The recent trend in the trade deficit has been encouraging to that extent after all the measures announced by the RBI as well as the government of India. Do you see that the negative sentiments associated with CAD is behind us now?
Well, I think that's what looks like. I mean, if you look at the reports that are coming out, everybody seems to have changed its currency forecast from rupee going to 75 to 58, or I think whatever level they are comfortable with. But I think having said that, the current account deficit problem is not sorted out as yet. If you look at why the CAD is coming down, one of the reasons is crackdown on gold imports. The gold imports, we believe, will be about 30% less than last year. And that's not, I think that's spilling over and having a lot of negative effects on the economy which we can talk about later. And then non-oil imports are coming down because the demand is at 12-year low. Private consumption demand is 1.6% in the last quarter. So with that kind of weak demand, some of the imports will come down. And then I think the oil imports will also reduce a bit because industry is anemic right now. So I think all of the reasons behind which are bringing the current account deficit are rather negative in that sense. And as far as exports is concerned, I think some kick to exports is visible, but in very limited sectors. I mean, only textiles, pharmaceuticals, and IT/ITES. Beyond this, I don't think there is any positive impact on any industrial sector because most of the sectors import a lot. I think so they lose out on that front. So I think having said that, unless I think if the situation continues, let's say, I think and we will see India remaining vulnerable because people will also price in these reasons. I mean, why the current account deficit has come down. So unless I think fiscal deficit and inflation are addressed, I think those are the fundamental reasons why even gold imports have risen. I mean, reason why gold imports or gold consumption is so high is because you look at any asset in India for the last 5 years, gold is the only asset that has given you a real return of 4 to 5%. None of the assets, whether it is equity market, nothing has fetched you any return. So obviously there will be clamor for gold, and it's not only for because people like to beautify themselves, but also as a very solid investment. So I think with inflation you have to tackle the fiscal deficit issue. Only then I think there will be a convincing decline in the vulnerability of the economy. Without that, I think we remain vulnerable.
The story of gold is extremely fascinating. I was reading the history of gold and the story of gold. India is the only country where purchases of gold are related to religion. There are occasions, religious occasions, when you are expected to buy gold. And I was thinking, with all those measures which the government has announced, if 1 billion Indians, and we are not 1 billion, we are more than 1.3, but say that 0.3 does not. If 1 billion Indians buy 10 grams of gold every year, I think it's 10 tons of gold already. So can you curtail through dictates and ordinances, or will it just lead to more of smuggling? I'm not sure. I would like to listen to the view of other panelists. How about you, Shekhar? Would you like to share something?
Yeah, in fact, you taking the words out of my mouth. I think it's like King Canute ordering the waves to go back. I mean, our finance minister said has appealed to Indians not to buy gold. I think gold is very, very fundamental to our culture, to our very lifestyle. And I do think there's nothing wrong in having gold as part of our portfolio. I think the important point as far as the current account deficit is concerned, it's now at an artificial level. They have actually, put in a number of measures, and as you said, the consistent raising of the duties, customs duties, is only encouraging the smuggling industry. Maybe they want that to become the culture of the country, and I don't want that to happen. I have very strong views on gold itself as part of the assets of India. I do think in a limited way, and I'm not very knowledgeable about it, but I do think the world will go back to a gold standard at some point in time. I think India can certainly position to do that. I do know that there are a lot of problems that are saying gold and making it tradable, etc. And the market for gold will somewhat be limited in the rest of the world. But I do think that gold in itself will come back. That's point number one. Point number two, as far as the current account deficit is concerned, I do think oil imports is something that we can't wish away. Right now, maybe the crude oil prices are a little benign at the moment, but if that were to spike, I think it'll put paid to our current account deficit number. Thirdly, I don't think our exports. I don't see the kind of entrepreneurial wave in the country that will actually take our exports to a new level. I think way back in the 90s, we had the software sector which was booming, which came onto the world stage on its own terms. I don't see any sector like that happening today. And for these reasons, I don't think this current account deficit is at an artificial level. It will go back to the levels once this customs duty on gold is removed and other announcements that have been made by the Reserve Bank and the Government of India are done away with. I think the current account deficit will come back to the vengeance and the rupee will go back to 78.
Gold is so fascinating a story, and I have been always thinking, before 92, when importing of gold was not legal, there was substantial amount of smuggling of gold. Now after all these duties were imposed, and we in the IIM Bangalore have privilege of meeting different officials, and I have been talking to some officials who are generally taking care of the customs. And I asked them, look, what do you think would happen if these duties go up? And they told me, you are a monetary economist, transmission mechanism takes 18 months to 24 months. But as far as gold is concerned, smuggling has already skyrocketed. Transmission is instant, right?
Do we have any statistics on the amount of gold that's been smuggled in the last 1 month? Has the Department of Customs put out these numbers?
If I knew, I would be in Ministry of Finance.
Signal that this is a skyrocketed, because if you look at the prices of gold, the supply of gold in the underground market or the black market has increased so much that the prices have collapsed. Actually, if you buy from organized segment, the gold is expensive. If you buy from the unorganized segment, again, it's at least 5 to 10% lower. And that is a reflection of the amount of quantum of gold that has
Market arbitrage.
I would be very careful. Would it come from China, where the gold riches in the foreign
I
market?
think it is getting imported in neighboring countries and then getting smuggled, because it's, some people were saying that it's causing macroeconomic imbalance in Pakistan.
I would say this case. On the gold, one more thought comes to my mind. Indians have 18,000 tons of gold I'm told. And I've been thinking in my own mind that US had asset-backed securities based on houses. Can we have asset-backed securities based on gold? These are some thoughts which come to my mind, but I would like to ask the experts. Dr. Anant, Anant Nageshwaran, would you like to share your thoughts on CAD and gold?
Well, I mean, if you can sort of activate my desktop, I can show an information that I had in a slide presentation. I don't know how it's going to be possible if you make me the presenter. Yeah. So now, thank you for that. So let's look at this way. Yeah. I think the government measures that have been taken since the rupee weakened substantially in summer months have been mostly in the direction of stemming the cash outflow or the demand for dollars, not so much as structural reforms that would address the underlying issues of the current account deficit. And one of the underlying issues has been the size of the fiscal spending, which has crowded out. For example, the size of the government net market borrowing program increased 9.7 times, and if you include the 1-year T-bill funding of another 1.16 trillion, you're talking about 32 to 37% CAGR in the last 8 years in terms of the increase in the government's borrowing program. And that exactly is what made our corporations also behave like the American subprime borrowers did. I mean, they went and basically, government, in order to deflect attention from its massive crowding out of private savings, liberalized external commercial borrowing, and we had roughly $50 billion of incremental foreign borrowings in the last 4.5 years. And servicing that is adding 1% to current account deficit. So the key issue behind inflation, the key issue behind the current account deficit is the fact that the Indian government is living way beyond its means, and much of the expenditure is not productive. And therefore, I think the whole issue of current account deficit being addressed through suppressing gold imports is like adjusting the symptoms. In fact, if anything, it only adds to the financial distress the Indians are facing. We control the fiscal deficit, and therefore we will automatically limit its monetization, which is happening by default. And to that extent, inflation rate will come down, real rates of return will increase for Indian savers, and they will automatically divert part of the savings from going into gold towards bank deposits. If anything, Indian household sector savings rate has stagnated in the last 8-9 years, except for a brief blip between 2009 and 10. So I agree with you on whether India should monetize and unlock the gold holding. By all means, they should try and do that. But the underlying issue lies somewhere else. It is the 800-pound gorilla in the room is basically the fiscal deficit and fiscal spending. And I think that if that is addressed, all these issues of demand for gold and the consumer inflation rate, rising cost of negative real rate interest, all those things will be addressed, and we will have a much sounder fundamental footing for the rupee. Until that happens, the rupee will always be a currency that is living on borrowed time.
I would like to invite the views of Dr. Gogren. Would you like to share some thoughts on this?
Yeah, I have, can you hear me?
Yes.
I have a few points to make in response to or reaction to what was said earlier. Smuggling is, as you said, Charan, is instantaneous arbitrage. There is no time lost in taking advantage of opportunity. But on the current account, I'm actually audible. I have seen behind some back and forth on my meeting.
Very clear.
Am I audible?
Yes.
Okay. On the current account, I want to highlight two factors which you did not bring out in your presentation, and that is contribution of reduced iron ore exports and increased non-coking coal imports to the current account. Our peak export of iron ore was in 2009-10, roughly $6 billion, $6.5 billion of iron ore. We are now down to about $1.5 billion. Now, I'm not questioning the merits of the judgment that has stopped iron ore mining, because obviously there was enormous environmental damage. But this is a direct hit on the balance of payments, direct hit on the current account, which has come in the last 2 years. As a result of this, not only are we not earning export revenues, but we are importing steel scrap to feed our furnaces. And I heard recently that some steel plants in India are also importing iron ore. So from a country which should be the world's leading supplier of iron ore, perhaps next to Australia or thereabouts, we are actually now becoming sort of, in some pockets, importers of it. The second is non-coking coal. We built up about 45,000 megawatts of coal-fired power plants in the last 5 years. Initially, the impression was that we would have to import coal for a short time to fuel these as our coal mining capacity is expanded, and you know what happened to coal mining capacity, licenses were issued and then withdrawn, the story is well known. But in this time period, the last 5 years, we've seen non-coking coal imports go from virtually nothing, a few $100 million, to $8.5 billion. Non-coking coal imports now exceed coking coal imports. Coking coal imports are 6 billion, non-coking coal 8.5 billion. So take iron ore and coal together, and without anything else changing, ceteris paribus, we have $13-14 billion hit on our current account. Nothing else matters. Gold, oil, all of those things have been going on, there are problems. But this is a hit which explains how your graph which you showed plunged so precipitously. So, we're in a situation where two very critical minerals, which are basically a source of great competitive strength for us because of our endowments of iron and coal, are really caught in a production logjam, which is not only having an impact, certainly having an impact on current account, as I just demonstrated, but also having a massive impact on other sectors, because all of these power plants came up on the assumption that domestic coal would be provided. And now it's only importing coal from Indonesia into Chennai or Paradip or Visakhapatnam, putting it on rakes, hauling it into Chhattisgarh, where the coal is sitting underground there. And then you're saying, well, how can we afford to generate self-power at the price that we negotiate? So now we have a Deepak Parekh committee recommending tariff renegotiation. The economics of power have gone completely haywire. Banks who have lent money to these power plants are finding it extremely difficult to recover their loans. So there's a massive spillover into other sectors of the economy coming from this problem. So I think we've got to address the fundamental issue, which is our balance of payments slipped so badly because of these two things. Other things, oil is known, gold is known, we can address those of course, but these two things have come into the picture very quickly.
I think uncertainty is a policy good, the public good. I don't think it should be given to the financial sector free. So the only way we avoid recurrence of the global crisis of 2008 on the top is to go back to how the world economy was. The financial sector was not the thing that got the job, but it simply has to be, asset prices have to reflect fundamentals. The whole notion that financial asset prices can drive economic fundamentals is completely flawed. And this intellectual foundation has come from the US, and only if that foundation can be overturned, will we be able to avoid the crisis of the stocks we saw in 2008.
Thank you so much. We have somebody from Toyota Kirloskar here, and you've heard him, Mr. Shekhar Vishwanathan, speak to us. I have a question for you. How did the industry manage the recent exchange rate uncertainty, especially those industries which have large import content? I think Toyota has a large import content. How did you handle the situation?
Yeah, you're absolutely right. We have a large import content, but let me just preface this with a little bit of history. Way back in 2008, we decided to expand our plant, and we went from 100,000 vehicles capacity to 310,000 vehicles capacity. For this purpose, we borrowed in yen. Now, borrowing in yen is a dangerous thing to do, simply because the yen has always historically, or in the recent past, has shown a tendency to appreciate very heavily against the rupee. So what we did was, we always have hedged our borrowings, i.e., what we did was, we said, we will not carry any currency risk. We swapped that yen borrowing into rupee borrowings, and we paid an effective rupee interest rate, which was actually still lower than had we gone out and taken a rupee loan. So that was one of the first things that we did. So, and I believe that a lot of industry has reacted in this manner. Some parts of industry did not do this, and they are paying the penalty. So one of the things that I want to tell this young audience is, never ever take an unhedged borrowing. Always hedge your borrowings in the currency in which you make your earnings. I think that's fundamental, and you've got to practice that completely. On our regular operations, our import parts, we have a huge import contingent, you're absolutely right. We import a lot of engines. A couple of things happened. One, of course, we were undecided whether we should make diesel engines or petrol engines. We ultimately decided to make petrol engines because we said eventually the government of India has to control prices. The market will decide whether they want diesel cars or petrol cars, and then we can kind of produce what is necessary. So we went with petrol engines. But after we went with petrol engines, we found that the government of India still not control this. They're still doing subsidized pricing for diesel, even though they've given that 50 paise per month uptick. The long and short of it has been that we've had to pay for these imports, and with the present rupee being what it is, can you take forward cover? Yes, you can take forward cover, but the premiums are way too high, so you can't do that. So what did we do? We tried to pass on these price increases as a result of our imports and the rupee depreciation. We tried to pass that on to the customer. Yes, the customer said, yes, you've got great quality, we'll pay for it, but only up to a point. We're not going to pay heaven and earth for the kind of quality that we know your products are renowned. So there comes a point when the customer will also start resisting your price increase. And that's exactly what's happened to us. From a capacity of 300,000 vehicles, today we are producing about 140,000 vehicles per annum. So that's the hit on industry. And that's the point that I want to really convey to this audience. The final point I want to make is a number of other points, but in the interest of time. The standard response that I get from the government particularly is, oh, why can't you localize? Yes, we can localize. We know we want to localize. We wish we could localize. First of all, localization is not an event. It's a process. You've got to get the right skilling done. You've got to get the right kind of technologies for the different parts that we import. And therefore, this idea and this notion that you localize and then you will have edged yourself completely is it's wrong. It doesn't happen in the real world, and this is something that I thought I should share with you. Thank you.
I totally agree with what you have said. I've spoken to industrialists myself, and they said, it's not the exchange rate, the rate at which the rupee dollar sits, it's the way it is going to come to that point. If it was gradually moving along with the fundamentals every year, there's a depreciation of 3.6%, we are happy, we can plan. Because investment needs planning, it just doesn't happen at the spark of the moment. You're very right. I also came to know the other thing.
Sorry, I can just add one more little snippet, and this is another takeaway. We had at one point in time, 3 years ago, we had planned actually to take our capacity beyond 300,000. We wanted to expand in India because the India story is, even today, is still largely good. But if you not even fill this capacity up, the bosses sitting in headquarters are going to laugh you in the face and say, you've not even filled this capacity, what are you coming to us with further expansion plans for? And do you know at what exchange rate it's going to settle down at? Or can you give us a band? Today I can't even give them a band within which the rupee will move. And that's really the problem that industry has. I'm sorry, Harry.
No, I agree with you, but I had a question. When you took the loan and the comfort accommodation, you went to Japan to take it itself. That's because that's where the parent company is from.
Yes.
Then in 91 we went to Bank of England, they refused us. I think that's a lesson. Okay, in the interest of time, I'm going to skip some of the questions which are pertinent on my mind, and I'm going to request the panelists, and I have my own thoughts on it, which I will share at the end. I'm going to request the panelists to take a guess, and that's most of the people here are students and not brokers and investors. But what would you think the US dollar rate should be now, and what do you think it would be in the month of March 2014? Should I start with you, Dr. Joshi?
I just want to mention here that right now, I think forecasting rupee is a random walk. I mean, the noise to signal ratio is so high in the system that there is no way you can forecast where the currency is going to be. So we make certain assumptions, and then we made assumptions on current account deficit and how it is going to be financed. So we feel that at least for this window, rupee will settle at 60. But even if it is at 60, mind you, the average value of the rupee will still be 12 to 15% lower than what it was last year. So there is still a very significant depreciation that has happened. But I think what's happening in the currency forecasting, I think it's more to do with psychology than to do with economics. I mean, in forecasting, we used to be taught recency bias, which means that most recent events weigh on your mind. I mean, the peak and the recent event. So when the rupee is falling, you just project the trajectory ahead, and when the rupee is rising, you just pull it ahead to a spreadsheet. And I think people forget that sometimes that these phases are temporary. There is sometimes it's an overcorrection that is happening. But I think that is the human psychology. I mean, there is no way to get around that. If you were able to get around that, then you would not have stock market booms and busts, and then profit making would become extremely difficult. Anyway,
Shekhar, do you do rupee dollar or only yen rupee? If you do rupee dollar, tell us what you think.
No, just to make that point, we do only rupee dollar. We took a yen loan, okay, and that is for our expansion plan. But all our imports are dollar denominated because we buy from Thailand, we buy from Indonesia and other places.
When there are no Indian revenue officers here.
Sorry?
No Indian revenue officers here.
To answer your question on where I think the rupee will head, we are doing our budgeting today at 70 rupees to the dollar. We believe that things will get worse before they start getting better. I think the J curve is going to take hold again. I think this little pause that you see, or improvement from 66 to 62, is, as Dr. Kokan mentioned, the effect of the shutdown, but the shutdown will go away, the US shutdown. And thereafter, things will get worse before they start getting better. But I look at a time frame of 18 months, not 6 months, before things start getting better. that is predicated largely on a new government being formed. And also, when it gets to 70 and, and a little beyond, I think exports will also start taking hold. The Indian entrepreneurial spirit will also hopefully start taking hold, and then we will find export markets. We have also been exporting from our country. Again, exports are not something that can happen overnight. To export cars to Europe or to Africa, it takes time to develop those markets. And today, every automotive player is here in India and is trying to export with this country.
Dr. Anantha Nageshwar, would you have a view on the Indian rupee?
Yeah, I mean, as Dr. Doshi said, anything is invested 2-year time horizon, the forecast is rather more than the cost of a coin. And we should also not forget that, I think if I'm not mistaken, in January 2014, Mr. Vedanta retired, and we have and we have Ms. Jayalalitha taking over. And she's extremely involved. And should the US economy sort of enter into a recession, the stock market collapses and a big correction, then she will be putting the paper on a very big freeze. Who knows to even increase the possible asset purchases to be possible for the Indian. So I think taking all these things into consideration, so there surely is no just a one-sided thing. At current levels, it's very difficult for me to go long on the Indian rupee on a 6-month horizon. So I would rather prepare to study the risk to reward ratio at this level. The reward to risk ratio is not in favor of going long on the Indian rupee. So that if I have it for the next 6 months. So that is my view as to what the exact level will be at 63 or 65. I don't care. The direction, in my view, in the short term is I'm not comfortable. But that having been said, should come to office and do things that I think she might do if the US economy and the stock market do not proceed satisfactorily from here on, then I think the Indian rupee will most likely head towards 58 billion. But right now, if I have to put a bet on it for the next 6 months, I will not be long Indian rupee at the current level against the US dollar. So that is the best answer I can give.
Thank you. How about you, Dr. Gokhale? What would your view be on the Indian rupee?
I really can't put a number up, but I want to highlight both external and domestic factors that will drive the value. On the external side, I think as we have been talking about, the progression of US fiscal policy and monetary policy over the next 6 months to a year is going to be a critical determinant. We don't see too many potential shock factors coming out of the other parts of the world. For example, Europe was such a turbulent place not so long ago, and now it seems to have stabilized into some kind of an equilibrium, not a very dramatic one, but at least there's not much instability coming from Europe. The other risk factor really is the potential for conflict in the Middle East. We saw some flavor of that when the Syria situation was boiling and oil prices just shot up in response to that, but they didn't stay up very long. That's when the rupee actually touched its all-time low in 368. I think over the longer term, the energy situation is going to change quite dramatically, given the very real prospects of shale oil and shale gas significantly changing the US's energy consumption pattern. So I think over that horizon, clearly, given the impact on India's import bills, that should point to appreciation. Other things remain the same. But in the short term, I think we've got to keep this list of risk factors in mind. On the domestic side, I think it's contingent on what we do credibly to address the current account deficit. Like I said, you can't have immediate payoffs for these measures, but even the signal that they send in terms of the trajectory will have an important bearing on what the rupee value is going to be. Let me give you a simple example of this. When it was known or expected that coal imports were tempered, even though they were quite large, there was one value of the rupee. When, as a result of the coal gate problems, this became almost like a permanent situation. There was a huge re-rating of rupees. So, temporary versus permanent drivers of the deficit are also going to have a bearing on what would be our market's value of rupees. So I think that's something we're looking about. The other thing which I would like to point out is, we have not talked about a rating downgrade for some time, but we're starting to see some mention in the discussion. And whether it happens or not is an issue, of course. But if the fiscal situation remains tense, remains difficult, and there aren't any clear signs of improvement, I think investors may get a little spooked about the prospect of a rating action, and if that happens, then there could be a preemptive kind of exit which could actually put enormous pressure on rupees. So that's a domestic risk, I think, which we should not underestimate. Addressing the current account, addressing the fiscal deficit are really the fundamental steps that we need to take, and there's no getting around that. There's no bypassing or sidestepping or substituting for those, whatever else we do, unless we tackle these two issues head on, risks remain high. And
Thank you so much. My own view is there is huge amount of uncertainty in the market, and that's going to sort of deteriorate the value of the rupee. I also feel that the current account deficit would be artificially controlled the way it was done in the last few months. I also feel the gross fiscal deficit will look very rosy for reasons which may not be true fundamentally. And therefore I think until we have a stable political environment in the country and that no need until the next election, the rupee will not find its true real value. Whenever it finds its true real value, I think inflation differential will play an important role. And my guess would be sooner than later, it will be around 68, 69, 70. As true for all discussions by economists, we play very safe, we give a wide spectrum, and today's discussion, the conclusion is the Indian rupee in days to come will hover from somewhere to somewhere. You all have appreciated my PowerPoint, which I had shown in the beginning. I would like to acknowledge it was prepared by my research assistant Sharda Shimpi, who worked really hard and the gross, global financial stability report. Now it's time to close, but before I close, I would like to open the house for 3 questions. 4 questions? Yeah, 4, 5. So, we have international linked up with people from Delhi. Dr. Gokhale is from Delhi, and Dr. Ananta is from Singapore, so we have to respect the time. So let's be brief. I would welcome a few questions. We will collect them, and then we will see whom the panel would like to handle them, and then we close. This is the question on real exchange rate, and this has been asked by Professor Apte. He wants to know what is the data on the movement on real exchange. So we will take that question. Dr. Ananta, the question is, what about the data on real exchange rates? Real, I did not provide the data, but real.
My question is, if it's so clear that the current account deficit is being artificially constrained at the moment, it's only a matter of time before the fundamental, actual, real current account deficit kind of again comes into play. Then why are the markets actually why is the rupee actually appreciated back to the 60 kind of level?
If not, we have 2 questions here. I'd like them to place before the panel.
I would like to raise one question which I raised earlier with Kamala Bhutinov also. I don't know how many of you have read this. The recent issue of Economist magazine, $10 to $17, has reported bond issues by several governments in emerging market economies. And they have listed a recent Government of India 10-year bond issue, dollar-denominated bonds, to coupon rate of 8.14%. Now I am wondering why this has happened. Because US government is issuing bonds at 2.36%. our rating compared to US government is not that bad that we should pay a premium of more than 6% on government of India bonds. So whether it's a reporting error or if not, then what is the cause of this such high cost of capital for Indian government?
So we have three questions here. One on RER by Professor Apte. The other one is again from Professor Apte saying, why in the Economist magazine there is that data at the end which shows that the government of India has been raising dollar-denominated bonds at 8%. And we have a question from Professor Krishna who says that why the rupee has appreciated back if fundamentals are yet not there. The fourth question is here.
Sir, good evening. I am from Christ University. Sir, I would like to ask, do you see that this recent appreciation in rupees is because of a structural changes in money, which is fallen from 68 to 61.5 in last month?
Again on the rupee, why the rupee has recovered. I would open it to the panelists. Anybody who would like to answer?
Why the rupee has rebounded in this situation? I think we have to look over the last 2 or 3 years very carefully at investment horizons. And my own hypothesis is that the reason why asset prices have been so buoyant in the wake of the crisis, despite fundamentals being somewhat removed or somewhat detached from that kind of market dynamism, is because we have had a displacement or crowding out of long horizon investments. The same people could do it, but horizons change. So when you have a market that is dominated by short horizon investors, trading sometimes called trading mentality, but I think the horizon is a differentiating factor. You tend to take advantage of whatever arbitrage opportunities you can see, and when there is a liquidity-driven boost to certain markets, to certain asset classes, people will try to take advantage. So the fact that the paper was postponed immediately, or the fact that the shutdown ensued, all of these have created windows from ranging from a few days to a few weeks to a few months, which have pushed funds into markets which are seeing effect. This is both currency and an asset or equity or wherever the funds flow. So I think that's the explanation. So which also then creates the has the implication that when there is normalization at that end, driving it, there will be a correction in market growth. We have to keep that perspective in mind. I don't really have any, I don't know the fact that, I have not been exposed to the fact that Professor Apte raised, so I don't really have a view on that. And I don't really have much to say on the RER. So with that, I hope, I hope you don't mind if I exit. I have another appointment very soon. So I'm just going to sign off. Thank you very much for inviting me. I hope it's been useful contribution.
Thank you, sir. I think Dr. Ananta Nageshwar, you come next. Yeah, and then in case you need to sign off, we are in India, we are used to starting late and sitting late.
I'll probably take another 10 minutes. We've got to do already. No, I think the RER, the data, of course, the RBI produces JP Morgan produces it, but we have the BIS data, and the Indian RER, if I recall correctly, as of the end of August, was probably below 100, and of course, BIS had already rebased its indices to the year 2010. So obviously, compared to 2010, the Indian rupees has had such a massive nominal depreciation that it has quite been able to offset and utilize the differential and yet show a real depreciation compared to 2010. So in that sense, I would say the RER is marginally has become more competitive, not to the great extent as Indonesia had, for example, of the in fact, this is to give a big boost to export. And that is why we heard from Doshi who said beyond pharma, IT-related services and textiles, it doesn't see too much of an impact on exports per se. So I think the RER is 5% below its base level of the 20% of the BIS, and I'm not sure it's really helping or hurting India one way or the other right now. I would like the appreciation, as Dr. Govind said, yeah, markets are driven by definitely short-term players today. Real money has existed, and in the US stock market, you definitely have algorithmic traders and high-frequency traders, and the fact that Indian interest rate is 8.5%, and whereas in the US it's probably close to 0 or 0.5. It gives some people an opportunity, and certainly I think the US certainly hasn't really helped matters with its handling of the tapering, with its handling of debt ceiling debate, rising debate, and also the government shutdown. So all these factors have helped flows back into emerging markets and into our benefit. So I really don't think we should use short-term market reaction or action as a justification for saying things have improved, therefore we should be confident. I think sometimes the market can swing in either direction one way or the other. 69 is probably overshooting on one side, 61 is probably an overshoot on this side, especially within a short period of time, and especially when fundamentals haven't really been up there. So I don't think market prices make us change our view on what India needs to do to put the rupee on a sustainable footing. Just one last point before I sign off, and I'll stay on the call though. Between 2002 and 2007, the Indian rupee appreciated against the US dollar. We went from 47 all the way to even 37, 38. And in that period, India had very strong economic growth, stable inflation by and large, so it began rising towards the tail end of the period. And we had a stable current account deficit, and despite government spending because of strong economic growth, we had a stable to slightly improving fiscal situation. So you really know what are the factors that underpin, and of course we had a very independent monetary policy at that point in time under Dr. Reddy. So we know the factors that enable the rupee to buck its trend of the last 20 years in that short period of 4.5 to 5 years. And those are stable to falling fiscal deficit, stable to lower current account deficit, strong economic growth, and stable inflation. We get them back, there is no reason why the Indian rupee is moving back towards 50 and 55. But without that, if it gets there, then it becomes overvalued and hurts corporate earnings. I hand over the podium back to you. Thank you.
I think I'd like to answer the question posed by Professor Apte. I think your question was with regard to why is Indian paper quoting at the 10-year bond quoting at 8.02%. Now, I don't know this for a fact, but let's assume it's not a typo or anything, and that's it's a real number. And I'm not surprised entirely, and I'll tell you why. First of all, I think it's a pricing of Indian risk in the international markets, and I think the markets are conveying a message to us. I think it's a very serious message. Second, if you look at the amount of foreign currency debt that we have, I think it's about $340 billion odd, of which something like $180 billion is maturing in the next 6 months. That's another statistic you may want to confirm.
278 is the foreign exchange reserves, and 60% of it is maturing within.
Yeah, okay. So it's about 180. So, I think these factors alone will push up the price of Indian paper in the international markets. Just to go back to a little bit back in history, particularly for the benefit of all the younger people in this class, and I think you will bear this out. In 1991, when we were running out of foreign exchange, the markets had started pricing. First of all, the market for long-term paper disappeared. Long-term loans, we had approvals to give loans to SBI and to Great Eastern Shipping and to ONGC and other mega borrowers. First, those lines were yanked. I used to work for a bank earlier. Those lines were taken away. Then came the short-term lines of credit. There was an instrument called the Banker's Acceptance in the New York market, which typically, where Indian Oil would go there, and through SBI issue a Banker's Acceptance, and we got short-term funding for 6 months. Initially, the pricing was like the BA rate plus 10 basis points. Then it climbed to 50, it climbed to 100, it climbed to 200. Then there came a time when lines of credit for all Indian banks were cut off. And finally, the only borrower was Indian Oil Corporation because and bankers were willing to lend to Indian Oil Corporation because if they didn't pay for their next consignment of oil, they wouldn't get any more oil. And the feeling was that a country will not jeopardize its oil payments, its oil supplies. So therefore, I believe that what you've said is right. It's a very serious thing. I don't believe it's the first of the morning sequence. In fact, I didn't pick it up thanks to you. I've got this bit of information, and I will certainly have it checked out. But this is the only point I would like to make in answer. Thank you.
Dr. Anant Nageshwar, at the end of The Economist magazine, if you see, I've seen what he was mentioning. If at the end of The Economist magazine you see, there is an entry against India, and it shows 8 point something.
8.14%.
8.14 for dollar denominated Indian. I was also
surprised. That must be the local currency benchmark 10-year paper, that 8.48% as of today.
No, dollar denominated bonds.
It's specifically mentioned dollar denominated. Even I was surprised. Okay, Dr. Joshi has something to share.
I just wanted to add that I haven't looked at the statistics as yet, but even if let's presume it were dollar denominated, the gap between India rating and US rating is very large actually. Yeah. US is only one notch below the highest rate of rating, and India is just one notch above the junk bond. So in between there is a massive notches, a couple of notches. If there were an India denominated bond, it would get reflected. I mean, just look at the Greek bonds and other countries in Europe. I mean, some of them have pretty high rates of.
I would like to thank Professor Ramesh for organizing this excellent event, inviting us to be here and allowing us to have the panelists that we have had. Thank you so much to all the panelists. Thanks very much Dr. Anant Nageshwar from Singapore joining us. Thanks Dr. Joshi and thanks Mr. Sheikh.
As I told you, I am the chairperson of CPP and I am also the event manager of this. Okay. So he was thanking me that I've been trying to be an event manager, and I thank all the people who really made it very successful. And for some time I was thinking, Charan, that you are really taking another session in monetary policy. And then it was so deep and then so conceptual. There was really a lot of learning, what we can really pick it up in 1.5 hours. And I think this also thanks to the panel. And this is, I mean, now you know the contrast between what is really a panel discussion and what happens in the TV, okay? So we just wanted to show you how we can, if you really back it up with insights and with the data, then how deep the panel discussion can. So thank you very much, and from this I'm also emboldened to organize many more such events, and you can look forward to it. I look forward to all your support, and thank you for participating in this. Thank you all.